Welcome to the Explainer from Talk Tickers. Today, we're breaking down the Toro Company's latest earnings call. And wow, it's a really interesting one. So here's the puzzle. How does a company beat on profit, miss on sales, and then see its stock, which was down big pre-market, end the day basically flat? Let's dive in and figure this out.
So right off the bat, the headline numbers were confusing. Toro actually beat what the analysts expected on profit, but they missed on sales. And just as you'd expect, the stock took a nosedive in pre-market trading. But then, something strange happened. By the time the closing bell rang, the stock had clawed its way all the way back.
And get this dramatic turnaround happened on huge trading volume, like 3 times the normal amount. So you know this wasn't just random market noise. This tells us that investors were listening closely to that earnings call, and something they heard in there completely flipped the script. So what was it? What did they find out that made them change their minds so drastically?
Well, the answer isn't in these big top-line numbers you see here. To really get what's going on, you have to understand that Toro is basically 2 completely different businesses masquerading as one company. It's really, a tale of 2 Toros.
Okay, so on one side of the house, you've got the professional segment. This is the part of the business that's absolutely crushing it, selling to big contractors and golf courses. But then, on the other side, you have the residential segment. This is the part selling to homeowners like you and me, and it is seriously struggling. And the gap between these two, it is just massive.
I mean, just look at the revenue numbers. It's night and day. The professional side grew almost 6%, really strong, fueled by big projects in construction and golf. But the residential side, yikes. Sales fell off a cliff, down almost 28%. We're talking about homeowners just not buying those big-ticket items right now.
And of course, that massive difference in sales flowed right down to the profit margins. I mean, look at this. The professional business got even more profitable, with margins expanding to over 21%. That's a cash machine. But the residential business, its margins totally collapsed, down to a razor-thin 1.9%. They were barely making any money there thanks to having to run promotions just to move inventory. In fact, the residential side got so weak that the company had to take a huge $81 million write-down on its Spartan mower brand. That's basically the company admitting that because of this slump in homeowner demand, the brand just isn't worth what they thought it was. That's a big deal.
Okay, so you've got one part of your business on fire and the other part is, well, getting exposed. If you're management, what's your game plan? Well, it looks like they have a 2-part strategy here.
First up, they are getting really aggressive on costs through something they call their AMP program. And this is key. This isn't just about cutting a few travel budgets for a quarter. They're talking about a major push for permanent, structural efficiencies across the entire company.
And the target here is a big one. They're aiming for at least $100 million in savings every single year by 2027. They've already found a path to $75 million of that. And they even dropped hints about an AM 2.0, suggesting there's even more fat to trim. That definitely got investors' attention.
The second part of the strategy is something they call pruning to grow. It's a great phrase. Basically, they're selling off the slower, less essential parts of the business, like the Trencor brand. Why? So they can take that money and that focus and pour it all back into the high-growth winners in that professional segment, like their horizontal drilling business. So with that 2-part playbook in mind, driving efficiency and focusing on the winners, let's look at what they're telling us about the rest of the year. Their guidance is, you could say, pretty cautious, but you can really see that underlying strength from the professional side shining through.
They guided to the low end of their previous forecast for both sales and earnings per share. Essentially, they're saying, look, we expect the residential business to stay weak for a long while, longer. You can see it right there. They expect the pro segment to be up a bit, but the residential segment to be down in the mid-teens for the full year.
All right, so we've got the good, we've got the bad. What does this all add up to for the stock? Let's piece it all together and make our call.
So here's the bottom line, the core investment thesis. You have this incredibly powerful engine in the professional segment, which is just humming along. Then you have the AMP program acting like a big financial shock absorber, protecting the company's overall profits. And these 2 things together are what's buying management the time and the capital to trim the weaker parts of the business and position that residential segment for an eventual recovery, whenever that might be.
And for all those reasons, our rating on the Toro Company is market perform. Look, that professional segment is a beast, and management's execution on costs is top-notch. That puts a really solid floor under the stock price. But
That struggling residential segment is a heavy anchor. It's probably going to hold the stock back from really outperforming the market until we see some clear, sustained signs that homeowners are ready to start spending again.
This is not financial advice.